right now, the economy appears to be pretty strong, right? The GDP numbers we're getting, while they're old for the fourth quarter, those are strong. The job growth, we just got the jobs report today, and boy, it's been strong, especially the headline job number. I could poke some holes in some of the internals in the jobs report, but that's been strong. And inflation, while making progress, it hasn't moved as fast as the Fed wants.
Welcome to Get Real 411, the podcast where real experts give real advice on all things real estate. I'm Jamie.
And I'm Brad.
Join us as we explore real estate successes and pitfalls through the eyes of our esteemed guests.
Now let's get real.
Well, we're super excited today to have Dan Habib, Chief Revenue Officer for MBS Highway, an industry expert. Dan has been recognized as one of the top 40 under 40. He's been recognized as a rising star by HousingWire. Just an all-around true industry pro. Super excited to have him today. Dan, welcome to the show.
Guys, thanks for having me. It's an honor to be with both of you.
Well, we are extremely excited, Dan, to connect with you today. You know, we've known each other for a lot of years, and I will tell you, just on the outside looking in, and I think a lot of people in the mortgage business would recognize and say the exact same thing. Watching you from that first time on video for MBS Highway and kind of a little nervousness, although you had some amazing education, like you already came in to kind of the business your dad had established through these decades of work and following the economics of our business. And you came in with some really just outstanding knowledge, but watching you grow over the last few years and just the confidence you exude and the way you analyze things, I will tell you, for me personally and for our loan officers, you bring with you just this level of comfort, I think. When we watch you, and of course your dad as well, for those of you who don't know, Barry is Dan's father. But you guys you bring kind of a peace to the updates you give us every day. It gives us the information that we need to speak confidently with our customers, our clients, our borrowers. And we appreciate you for that. And, it's funny because you come into everybody's home or office, and people think that they know you, but you don't know them. But believe me, you're having an impact.
Well,
and so,
that was
super excited to have you.
That was incredibly nice. So thank you, Brad. I truly appreciate that. And, I was kind of born into the mortgage industry. I don't think many people when they're young, they're like, what do you want to be when you get older? I want to be a mortgage professional, right? But I was one of those people because my father has and still is my hero and mentor. And I was blessed to have a father like him to teach me. I mean, he's certainly a giant in the industry. And boy, if I can, be half as good as him, I'll have done a good job. So.
Well, you're well on your way.
You are. You guys really are the gold standard, right, for the market. And what I love and have always appreciated about MBS Highway is the fact that you speak at a level that anybody can understand. You make it understandable. You make it something we can digest. Because I think that a lot of loan officers out there, they hear the things that obviously the news reports, which is not always timely nor accurate, but also they feel like they should be experts on the market. They feel like they should be able to answer questions that some of their more savvy clients and real estate partners ask them. But other than MBS Highway, there's not really a digestible format for us to understand all of that. So definitely hats off to you for that. It's certainly a tool in all of AmeriFund's loan officers' arsenals. It's just, we feel like it's a necessary thing. It is necessary for us to be good stewards of our industry and to understand the market and its implications on our clients.
Well, thank you very much, Jamie.
Yeah, I echo that, Jamie. So what I'd like to do, because, we have kind of varying, a varying audience here. I mean, a lot are from the mortgage industry. Some are just, in real estate in general. And then some consumers is just a little bit deeper introduction of you. And then we asked you if this would be okay. You said it is. Just a little bit of your background, like how you grew up, where you grew up, how you actually got into the business. I mean, did you literally say, I want to be a mortgage broker when I grow up? Or did you try other things and, your education, that sort of thing, just kind of bringing us to today. It'd be great for us to have that, but Dan, there's a certain level of authority that you bring with the information that you share with people. And I want people to get that out of this session. For those that, are subscribers and those that aren't, just knowing that there is a resource there that honestly they should tap into every day. I start my days off by watching the video. I do it. It's in the background. Sometimes I'm tied in directly and I'm watching the whole thing, and other times I'm just listening and doing some other things. But it sets the stage for me on what to expect for the day and the week to come. And so let's just roll back the clocks a minute.
Yeah.
Give us a little bit of your background, and then tell us how you got to where you are today.
Yeah, I'll give you a quick timeline. So, grew up running around in my dad's office. My dad was, one of the top mortgage professionals. At one point, he owned his own mortgage company and then worked for several others. And, when I was a little kid, a lot of the time I spent with him, because he was a workaholic, was my twin sister and I running around his office, doing races in the hallways and kind of hanging out, waiting for him to get done with work. So I always, looked up to my father, wanted to do what he was doing. And I started to work with him as I grew up, but, kind of helping out with some of the office tasks and things that I could assist with when I was very little. But, I then went to college at Monmouth University in New Jersey. I had a finance degree. And it really wasn't until I was about halfway through college that I started to really work with him. Back then, this is when he created Mortgage Market Guide. And I'll never forget, he was one of the top mortgage producers, and he sat me down in his family room and he said, Dan, there's so many smart people out there, but you know what the difference is between somebody that's smart and somebody that's successful is just going out there and freaking doing it. Right. And he's like, listen, I know this is a big risk. I have a very successful mortgage business, but he completely transitioned to Mortgage Market Guide, which was around 2001, which was a platform that we created that was the first of its kind in the mortgage industry, and really educated mortgage professionals on what's happening in the market, make them better advisors to their customers, increase conversion through knowledge. And then also a big part was our alerts. And this was before Dodd-Frank. So, people could save or make a lot of money based on the timing of those alerts. And, I say we started it. I was still a very young man. I was in college, but I started the sales team. So I saw him kind of going across the country and really breaking his back at different speaking engagements. And we were getting signups from that. And that was really the main driver of our new subscribers. So I created a sales team, and I was in a fraternity. I recruited like 10 of my fraternity brothers. We had a lot of fun, but we were really successful. And that's kind of where it started for me on a more serious level. Now, I'll be real with you. I'll share some things with you. I was a little bit of a wild man when I was younger. I'm sure many of the people on this call could probably relate to. And, I was blessed with opportunities that many people don't get blessed with, right? I mean, I like to think now I really work hard and try to not take those opportunities for granted. But back then I was very young. I was in a fraternity and I wasn't doing the right things at one point in time, where my father, I'm happy he did this because I think it's part of the thing that turned me into the man I am today, but he fired me because I wasn't showing up and I was setting a bad example. And, especially being Barry's son, you need to set the right example. Otherwise, what does that say for the rest of the sales team, the rest of the company? So then, and nothing against what I'm about to say, but then I went and I worked at Sports Authority while I was in college, and all respect to people in that profession. But I was merchandising shoes, and it certainly wasn't where I wanted to be in life. But he ended up giving me another opportunity. And I think I took that opportunity seriously. And we grew Mortgage Market Guide, and it was pretty ubiquitous within the industry. And then we had a successful exit. We had a private equity firm come in and invest. And, this was, the timing on it was incredible. It was literally less than 2 months before the housing bubble. So you can imagine tensions with this new company that had now acquired us, and they're trying to get rid of everybody and replace them with, young kids. And we had certain loyalties with these people that worked with us forever. So there was some tensions. We had a non-compete. We ended up leaving the company, had a non-compete for 2 years. Over that period of time, I was always, a student of the markets, very interested in the stock market, the bond market. And I actually went and worked at Morgan Stanley as a financial advisor. So got all my licenses, 63, 65, Series 7, 31 Life Health, you name it. And boy, that's a challenging business to, break into, right? Especially when you're green, people, you're trying to get them to give you, their millions of dollars of life savings and you just started in the business. It's hard to build that trust there. But I was lucky to be a part of the #1 Barron's ranked New Jersey financial advising team with a man by the name of Ed Moldaver. For you sports fans out there, one of the members of our team was Wayne Corbett, famous receiver from the Jets that, had a big heart and would run over the middle and get clobbered. And me and him shared an office for a few years while I worked there, and started to really grow my book of business there. It's really all about relationships and getting that assets under management and such. But then I had gotten a call from my father, and he wanted to start MBS Highway, and this was about 12 years ago. And we had so many people since we had gotten out of the business that wanted us to come back. And, I'll be honest with you, when we first came back, I couldn't say no to the opportunity to start this with them, really more as like a partner. So I left Morgan Stanley, started this, and, I remember there was some challenges initially, right? So we gave it for free for quite a bit of time. And we instituted new technology. Instead of just like written updates, we started doing video updates and such. And really, we started growing a little bit with all the free members. And then we had a database issue. Our tech team at the time lost them. So we had to start over. It was a nightmare, right? So this was very early on. Then we rebuild, and, we started gaining subscribers, and we got to a point where we were like, man, we're kind of like plateauing here and we're not where we want to be. So we had to, I think, reinvent ourselves a bit where, after Dodd-Frank, the alerts still very important, but not as important. So what did we do? We started doing much more in the way of data and tools and purchasing a lot of data, making it very usable where you can show customers the opportunity in homeownership in their specific zip code, providing resources to realtors, and then really creating, I think, really easy to use but elegant tools to help mortgage professionals in any scenario, whether it's buying versus renting, comparing loans, showing them why they shouldn't wait for rates to come down to buy, the cost of waiting, different things like this. And, luckily, with some hard work and a little bit of luck, certainly, proud of the company that we've created today. So that's a little bit of a journey of my professional career.
Yeah. And you have a lot to be proud of. I've been fortunate with Brad to watch the evolution of MBS Highway from truly just the alerts. And by the way, Brad's probably one of your original clients, which is awesome. We're so glad we've been able to, grow the relationship with you guys. But, to watch that, I can tell you how, back when I was actively originating, and Brad shares this belief with me, and we really do practice this at AmeriFund. We believe that there are 3 essential tools that you need as a loan officer. One of them is obviously a really good point of sale tool for your customers. The other is, is to have something that can present options to your clients and to your real estate partners in a way that's easy. Not just easy for you to do the input, but easy for them to understand. There have been other similar situations, similar software solutions, but they're very complicated. And most consumers don't want that. They just want to see some options side by side. The cost of waiting is probably one of the best tools in the arsenal. The rent versus own, another great one in the arsenal. Just to have seen it kind of evolve from where it started to where it is today, and to know how many successful originators are using it as, again, something that I consider that, along with the CRM, the 3 things you have to have. You have to have them if you're going to be serious about your business, and if you're going to be serious about really understanding the market and being able to advise people correctly.
Awesome. Well,
Yeah,
thanks, Jim.
that's right. So Dan, thank you for sharing that. I think what it does for people is it helps them to understand that everybody's got their own path, right? And so, especially in our business right now, in the mortgage business itself, we went through these very robust years where basically didn't know what you didn't have to know anything, and you get loans and they fall in your lap, to probably one of the most arid seasons ever. And I would say it's not even akin to 2007, 8, 9. That was a different environment. Where it was kind of like most people just got out because it was just so different, and those that stayed in were carving a new path. This is like just people hanging on, right? Having a fraction of the business, and you could probably correct me if I'm wrong, but we lost something like 100,000 licensees at the beginning of this year.
You know what? I got a pretty good slide I could share that I think
Ooh.
the
That'd be
listener
great.
would probably be interested in, right? So take a look at this. So we have this data with, we acquired MBS Highway, which we're now the Highway brand. We acquired List Reports last year, and
Yeah.
boy, they have just every transaction data on the LO and realtor side. So we're able to pull, I think, some unique data that is better than anything else out there. Now, if we look at 2023, if you want to say what's an active LO, there's different ways you could do it. People look at licenses, but that can be a bit flawed. Just because you have a license doesn't mean you're an active LO. Maybe you didn't close a loan in the last year. I don't really consider you an active LO. Or maybe you fall under a federal bank's charter and you don't have to have an individual license. So the real way to look at it, at least in our eyes, is in 2023, did you close at least one loan? We'll consider you active. There was 234,000 loan officers that closed one loan last year. Now, how many are active today? Well, if you haven't closed a loan in the last 90 days, you're probably not an active LO, right?
Yep.
Maybe there's some out there, but most likely you're not. So out of the last 90 days, only 134,000. So like you mentioned, you were pretty spot on, like 100,000 LOs, right? Or
Wait, let me calculate this. I think I was exactly spot on.
yeah. So about 43% attrition. So like we joke around here and we say, if you watch Squid Games, congratulations, you
Right.
made it to the next round.
Yeah.
Right. So it's been an extremely challenging market, both in mortgage and real estate. And, I think people would be surprised to see what the average production numbers look like too. Right. So of the active LOs, if you want to know what's that 50 percentile level, meaning half the LOs did more transactions than this and half did less. Well, 50 percentile mark there is 5.3 million for 18 loans, or about 1.5 loans per month. Not that much, right?
Yeah.
Top 25% is 11.6 million. 38 loans are about 3.2 a month. You can see the top 10%, top 5%, 100 loans are 8.3 a month. And if you want to be in the top 1% of all mortgage professionals, 64 million, 180 loans are about 15 per month. So those are the stats, team.
Wow.
And, it's
Incredible
been a challenge.
data.
Obviously, we have, a lot of headwinds, and rates being the primary one, where everybody's, I think there's a lot of pent up demand on the sidelines, but rates are still elevated. We can get into some of the reasons why and where we see that going, but the Fed's definitely going to play a big role this year as well.
Yeah, let's put a pin on that for a moment, just because I want to point out the information you just shared. And for those on audio, you're going to want to go to the YouTube channel and pull up the video because, and maybe even take some screenshots, but that data right there is exactly why people need to have your information in their arsenal. So you mentioned you guys acquired List Reports last year. I actually know the founders and those that put together List Reports. And when they were selling it, I didn't know it was you guys buying it. I knew they were selling it, and I knew they were going through the negotiations. And once it was announced, I'm like, oh my gosh, that totally makes sense. Mm-hmm. So that was such an amazing acquisition because it was an element that really complements what you guys have been doing, because now you have all these tools and everything there. You bring in all this data, and not only the data itself, but the way that they display data, the way they connect with the real estate industry and production on the real estate side is so powerful. And we talk about, I'm going to tie this into something we're working on right now. We're working on a 90-day blueprint. So what we found as we recruit and we continue to grow is there's a lot of people that are migrating from what we call retail now to broker. And I just like to call it like going from, a banking institution or some large retail lender to, an independent, right? That's really what it is you're making the shift from, having maybe this flow of business that you're not really responsible for to having to build your own business. And when they do that, they may have been very successful on the other side, but starting it on their own and doing those things like building a database and that sort of thing, like it can be templatized, but they don't know how to do it. They need a mentor. They need somebody to show them. So we're building this blueprint. Well, part of that blueprint is exactly what Jamie said. And you know this because we've been putting together a tech package, which includes your information, because we know how valuable that is. So I just wanted to pause for a moment and say that data you just presented, that just came off the top of your head, you had the slide, you probably didn't have it on your desktop, you just knew where to find it right away. Like that is the power of having this information at your fingertips if you're in the mortgage industry. And it does lead to business. It leads to business. This knowledge creates power, which leads to business. When you can speak effectively as an authority in the business to your customers, to your real estate agents, to your referral partners, they're going to trust you more, but they should trust you more because you know more than the average person that's out there originating loans. So, I just wanted to pause for a moment, but I do want to go to what you just said, which is interest rates, because that is the talk of the day, right? What is going to happen this year? It is an election year. Are we going to see rates come down? I mean, we've been thinking they're going to come down for the last 2 years, and they haven't. The Fed will play a big part of this. So we'd love to get your insight to share with the audience here. And I think it's timely. We just started Q2 of 2024. What is in store over the next, quarter or two?
Yeah. So I think it's important to first talk about why rates are elevated, how they got there, why they haven't improved like some others would have thought. I mean, listen, we thought rates would have improved more over the last year as well, and they haven't. So there's a couple of extraordinary type events that happened that hurt us. But let's start from the beginning, right? So we know that rates were really, really low. And this was, partly due to the Federal Reserve cutting rates to zero. They were buying trillions and trillions of dollars of mortgage bonds and treasuries. This was called quantitative easing. And there was 5.2 trillion in stimulus that was also given out, right? So this is all the efforts of both the administration as well as the Federal Reserve to stimulate the economy after the COVID crisis that we had. But there's unintended consequences that occurs there, right? So, the Fed bringing rates so low and keeping it there, even as inflation moved higher, they did so much buying that they artificially kept rates sub 3%. This caused everybody to refinance, caused everybody to purchase homes. And listen, they were successful in helping stimulate the economy. When money's cheap and almost free, people are going to borrow and expand and such. But the unintended part is, hey, you put so much money out there, you make rates so low, you're going to create some rapid inflation, right? The definition of inflation is too many dollars chasing too few goods. Well, we had supply chain issues, partly due to COVID. And then we had all of this additional money out there in the economy. And we had this big inflation problem where inflation rose to 40+ year highs on the consumer price index. It was up at one point about 9% year over year. So inflation in itself is never a good thing for mortgage rates, right? Because inflation literally erodes a bond's fixed rate of return, right? So, if I were to lend you, Brad, or if I, $100,000 and, rates are 4% and then they go to 8%, well, that loan is not going to be worth the same amount because in the going market, you can get double the return, but also your fixed rate of return that you're getting, it's not going to be able to buy as much, right? Inflation's eroding that fixed return. You go to the store, you can't buy the same amount of things that you could when inflation was lower. So when rates go up, typically investors demand a higher rate of return, a higher rate of interest to combat the faster pace of erosion due to inflation. So typically when you see inflation go up, mortgage rates go up. When inflation comes down, mortgage rates go down. Now, if we look at inflation today, if we look at the Fed's favorite measure, which is called the core PCE, what is that? So there's two main inflation readings out there, the consumer price index and personal consumption expenditures. And within both of these reports, there's like an overall inflation number, and then there's something called the core rate. So the core rate, it strips out food and energy prices. Now, you guys might say, well, why aren't we including that? I spent a lot of my money on food and energy, right? And you do. However, the Fed doesn't feel that they can influence that with their monetary policy. And we'll get into what the Fed's been doing, but you can have geopolitical turmoil. You can have events like we just saw, airstrikes in Iran, drone strikes, in the Middle East. And all of these things, the refinery, one of the largest refineries in Russia getting hit by Ukraine, all these things can cause the price of oil to go up. And we've recently seen that happen. The Fed could hike all they want. They can't control those price increases. And you could have similar things happen with food, whether it's bad weather, bird flu causing eggflation. So the Fed, when they do their monetary policy, AKA hiking rates, they want to see if they're having an impact. So they strip out food and energy. They look at the core inflation, and that's really their benchmark as far as, hey, what are we doing? Are we doing, do we have to hike more? Do we have to cut? So they're looking at inflation as one of the key indicators out there. Now, inflation has come down quite a bit, Right now, core PCE is at 2.8%. That's the one that the Fed wants to see go to 2%. Now, they've made it clear they're not going to wait for it to get to 2% before cutting rates, but they want to be confident it's heading there. And the truth of the matter is that it's kind of stalled the progress over the last few months. It's going to be very hard for them to get all the way down or confidently down to 2%. But even without that, we've seen the core PCE get cut in half from the peak. And normally when you see that kind of improvement in inflation, you'd see rates improve more than they have. But we haven't seen that. Reason being is supply. We have removed the debt ceiling last year. The US has a spending problem. We continue to deficit spend, continue to add to our debt. But this money, we don't have a printing press. You know what I'm saying? We issue treasuries to come up with this money, right? So we issue debt. So our treasury has been auctioning off record amounts of 2-year treasuries, 5 years, 7 years, 10 years, 20 years, 30-year bonds. And all of this supply has to be absorbed by the bond market. Also not helping the supply issue is some of the banking crises that we had last year. The second, third, fourth largest banks going under. All those assets that they had, most of it in mortgage bonds and treasuries, that got auctioned off by the FDIC. Other banks in general had to sell a lot of their assets, like mortgage bonds and treasuries, to come up with depositor money, because there was literally a run on banks because there was a better alternative. The Federal Reserve, to curb inflation, hiked 525 basis points. Well, that has a direct impact on things like credit cards, car rates, money market accounts, short-term treasuries. And then it was well, why do I want to leave my money in a bank deposit account getting a fraction of a percent when I can get almost 5% in a money market account virtually risk-free? So they had to come up with depositor money so they can have that money for depositors. So all of these things caused a lot more of supply to come to the market. The US got downgraded for our credit rating. You guys in the industry know what happens when the customer's credit goes down, right? Then the rate goes up, right? So all of this is really the reason why we haven't seen rates come down, even though inflation's made good progress, albeit it's not at the Fed's target of 2%. And then, Brad and Jamie, the last thing I'll just add on that point is to make matters worse, the Federal Reserve, remember we talked about how they were doing quantitative easing after COVID. They've been doing quantitative tightening today. So quantitative tightening means that they've been reducing their balance sheet. So all of their buying, they amassed a balance sheet of $8.5 trillion, mostly of mortgage bonds and treasuries. Well, they said this is way too high. We need to normalize this and reduce this balance sheet. And they've been doing so of approximately $95 billion a month that they've been reducing the balance sheet. So you have all this supply coming to market from debt and whatnot. And then the Fed's not only not buying, they're reducing their balance sheet by $95 billion a month, or 1.1 to 1.2 trillion a year. So this is kind of the perfect storm as to why we haven't really seen mortgage rates improve, if that makes sense.
See, again, you explained it in a way that does make sense. And that resonates with me. But I guess the next question is the crystal ball. So what happens next, right?
Yes.
So that's what got us to where we are today, which is a great explanation. And folks out there, you could very simply describe that in 2 or 3 sentences for your borrowers on why rates are so high, and the complexities of the global issues that are affecting it. But what they're really interested in is what I just asked, which is, okay, well then what happens next? And then I want to tie that into some of your tools, which is the cost of waiting. Okay, we may expect our rates to go down. We're not sure when exactly, but why should I buy now instead of waiting for that, and what the effect looks like? So, but let's start with, what's next.
Yeah. So the Fed has a dual mandate. They are looking at stable prices, also known as inflation, and maximum employment. They don't want to see the unemployment rate go too high. So right now, the economy appears to be pretty strong, right? The GDP numbers we're getting, while they're old for the fourth quarter, those are strong. The job growth, we just got the jobs report today, and boy, it's been strong, especially the headline job number. I could poke some holes in some of the internals in the jobs report, but that's been strong. And inflation, while making progress, it hasn't moved as fast as the Fed wants. It hasn't gotten, in their eyes, confidently towards 2%. the reason I bring this up is because everybody wants to know, when is the Fed going to cut rates? The Fed went on one of the fastest, most aggressive rate hike cycles that we've seen in history. They hiked 525 basis points. So now the Fed funds rate's in a range of 5.25 to 5.
Over what period of time was that hiked? Can you remember?
Yeah, it was
it like it was less than 2 years?
Yeah, it was a year and change. But remember, they were doing 75 basis point hikes at a time at one point, several in a row. So everybody wants to know, when's the Fed going to begin cutting? And we've heard from many, many Fed members. We saw them at their last meeting talking. They've been on parade this whole last week. There's been numerous Fed members, and they're all basically saying the same thing. They expect some cuts this year, some saying now only one, some still in favor of 3. But they're saying that we don't want to start cutting. We have time to be patient because the economy looks strong. We want to wait until we're confident that inflation's heading to our 2% goal. So key things to look at, which will help determine where our rates go, because if the Fed starts cutting, that will help things. But there's something else I think that's big that may come before rate cuts. And I'm going to talk to you about that. But first, we have to understand inflation. And I want to show you why I don't think inflation alone is going to be enough to get the Fed to cut rates. So just take a look at this slide, and I'm going to let you behind the curtain, and you're going to know more than 99% of people about how inflation actually works. So remember, the Fed is looking at core PCE. The last reading was 2.784%. You round that, it's 2.8%. Now, when we get the next reading on inflation for the core PCE, which will be the end of this month, there's going to be a few things that happen. We're going to get a new monthly reading, and what it's going to do is replace the monthly reading that we got last year. So at the end of April, we'll get the March reading, right? So let me just show you. We'll get the March 2024 reading. So that means that in the year-over-year calculation, the March 2023 reading is going to fall off. So let's do that math. Right now, the exact core PCE is 2.784. When we get this new report, the March 2023 reading is going to fall off. That reading happened to be 0.336. So let's subtract that out. The 11-month total of inflation after you do that is 2.448. Now, we can speculate, what is this new reading going to be when it comes out? And then we can see what impact that would have on the main figure the Fed is looking at, which is year-over-year core PCE. So if we take a look at what the estimates are out there, it's for 0.23. So if the estimates come true, if it's not hotter than that, it wouldn't improve that much. It would only improve to 2.678, which it would be rounded to 2.7%. So it would go from 2.784 to 2.678. You might get 1/10 of a benefit on a year-over-year basis, but that's not going to be looked at from the Fed as making all kinds of progress. It's very, very slow. They're going to look at this as, not being confident yet that it's heading to their 2% target. And then it gets harder as we go on later in the year. So remember that exercise we just went through, right? So we just showed you for March, it's going to be released April 26th. What happens to the core PC, right? But then assuming we only get 2/10 readings going forward, which has been less than we've been doing, and you take a look at the replacements and the impact, take a look at this. By September, you only get down to 2.6%. Remember, we're at 2.8 right now. So you're not going to be able to make progress. And part of the reason why it's going to be more difficult is some of those numbers that are going to be falling off the annual calculation, they're low from last year. The replacements are low. So if you just look at inflation, and we're making some reasonable estimates here, what happens if it comes in at 0.3? Forget it. It's going to be higher than this. It's going to be hard for the Fed to get to 2% inflation. In order to do so, you have to average over the course of a year 0.167. And the numbers we've been seeing have been closer to 0.3 or above. So it's going to be hard, especially if oil prices remain elevated, even though that's not in the core. It finds its way in. Airline fares and things of that nature, those go up with oil prices going up, and that will impact the core. So bottom line is, I don't think inflation is going to be enough. What I think could do it would be the unemployment rate. Now, at the Fed's last meeting, they released what's called their SEP, or their Summary of Economic Projections. And basically, there's 19 Fed members, and they all make some projections where they think inflation's going to be, how many Fed cuts, where GDP is going to be, and of course, where's the unemployment rate going to be? Well, if you look at their most recent projections, 6 Fed members don't see the unemployment rate going above 3.9%, some above 3.8. 11 Fed members don't see it going above a range of 4 to 4.1%. So 17 of the 19 Fed members don't see the unemployment rate going above 4.1%. If you look at the median, it's 4% actually. So right now, the unemployment rate, it was just 3.9. Today, it came down to 3.8. So that didn't help our argument for maybe the Fed cutting, but it's still not far away from the Fed being surprised, right? 3.8%. If that goes up to 4%, a lot of Fed members may change their tune on rate cuts. If that goes up to 4.1%, forget about it. You're going to see Fed members come out and saying we need to cut more aggressively and sooner. So that, I think, is a catalyst and something to watch out for. The jobs picture is going to be critical because, as we just went through, I don't think that inflation is going to get there to make the Fed cut.
Yeah, look, I think people can relate to the inflation conversation because it affects everybody's everyday life. Like when we look at airline flight costs, when we look at rental car fees, when we look at anything that affects us, and again, taking out the core, food and that sort of thing, as you mentioned, that they're not tracking. Although for us, they're just living our lives. That's a big deal, right? And so it is hard. I love your explanation for that because it is hard for people to understand why are they not taking that into account. Of course, that's inflation. Look how much I'm paying for eggs. Look how much I'm paying for milk.
I want to add one other thing on that, Brad. The thing is I think consumers get a little bit angry because they see people in the media talking about how inflation has really cooled off and made a lot of progress. But consumers out there are saying, what are you talking about? I haven't seen prices go down. It's way more expensive when I go to the store, when I buy these services. And they're right, because you have to understand that we're not talking about prices going down. We're talking about the rate of inflation decelerating.
Yeah.
Right. So listen, over the last 5 years, you probably saw about 25% inflation. That's all still baked in. Unless you see negative year-over-year inflation numbers, prices aren't going down. In the Fed's utopian world, we are only going to see prices rise at 2% per year. So that means that right now we're at 2.8. They want to see the rates of increase come down to 2, but that doesn't mean that anything's happening with those already price increases that we have baked in.
That's right. And I think that's how, when I think about it, again, without the background and education that you have, but just, relatively thinking about how inflation has affected the consumer's life over a long period of time. When you look back at, the cost of gas in the 70s and the 80s, and then moving up in the 90s and everything like that, and then wages increasing. Every time there's kind of that whole thing about every time there's an action, there's a reaction. People talk about, well, the living wage needs to go up. Okay, the living wage is going to go up. Now you're paying, people are flipping burgers for $20 an hour. That's what's happening here. Just went in place last week in California. Okay, what do you think is going to happen? It just means that the cost of those goods are going to go up to compensate for the higher wages, which means everybody's going to pay it. And that's how we see this kind of cycle go on and on and on. So it is interesting to have you, comment that we're really not going to see that unless we see deflation, right? Where there's actual costs and goods are going down as opposed to the rate of inflation slowing down. And, when you describe it like that, what I hear as somebody in the mortgage business, somebody who, speaking with loan officers that are originating loans every day, it's what I hear is, okay, we're probably not going to see rates really improve that much this year. What I think the hope was, and maybe we can talk about this for just a moment, is because it's an election year, because the way that people perceive inflation and the cost of living is based on the administration that's in place today, and they don't like the way that affects their ability to get rehired, to be elected again, is the pressure from that side of things. What effect, if any, can that have on the Fed making a move on pressuring to get rates lower so that they can be the champions that made this happen?
Yeah. So you said a couple things there I'll comment on, right? So first of all, wages have been increasing at a good clip, but up until recently, they weren't outpacing inflation. So, doesn't help you. But if you do have a regime or a period of time where wage growth is is surpassing inflation, things can get a little bit better from that perspective. But for a long time, inflation was higher than wage gains, and you feel that as the consumer. But election years, I mean, first of all, listen, politics is dirty, right? but I don't like to speculate on some types of theories out there and such. But what I can tell you is this: the Fed, they've come out and said this many times, but they're supposed to be completely independent, right? So they are not supposed to be influenced at all by an election year. But there's many people out there that would say, you know what, when we get closer to election time, I think the Fed's going to cut, right? So we don't know, but they're supposed to be independent. But I think rate cuts would certainly help mortgage rates indirectly. I think if inflation continued to come down, that would help mortgage rates. I think if the unemployment rate went up and the economy started to show signs of slowing, that would help. But there's something else big that nobody's talking about that I think could come at the June meeting. And I think that this could provide some assistance to mortgage-backed securities and in turn mortgage rates. So I want to go over that because I don't think many people are aware of this. It was said at the last Fed meeting, and Fed Chair Jerome Powell in his press conference talked about their balance sheet. So if you remember what we talked about earlier, the Fed has been reducing their balance sheet. They're doing quantitative tightening is the buzzword there. But what they're doing is allowing assets to roll off their balance sheet. But he said they may start tapering the balance sheet reduction fairly soon, was his quote. Now, he said this at the March 20th meeting. To me, that means maybe May, but most likely the June meeting. And the reason being is they are fearful of liquidity issues. Yeah. So we have to break this down step by step to understand it, right? So the Fed, remember we talked about them doing all that buying. They amassed this $8.5 trillion balance sheet, mostly mortgage bonds and treasuries, and now they've been reducing it. Well, what they've been doing is all the proceeds they receive from the nature of the assets they have on their balance sheet, whether it's principal payments, people, refinance, they have things that mature. They receive all this money. Remember, they have $8.5 trillion of these assets, and then they're allowing up to $95 billion of it to roll off the balance sheet, meaning to fall off. However, if they taper
what do you mean by fall off? I don't understand that.
I'll explain this.
Does that go back into?
So if we go back, so when the Fed was buying, right, they were doing quantitative easing. So they were outright buying mortgage bonds and treasuries. Then they stopped outright buying, but they kept their balance sheet net neutral, which means they were secretly, not really secretly, but most people didn't know this was happening. They were still being extremely stimulative to the mortgage bond market because any things that mature, any principal payments they receive, they would reinvest it back into mortgage bonds. So essentially, instead of their balance sheet naturally reducing as these things happen, it would stay the same. And any of the money that would fall off, they would reinvest to mortgage bonds and treasuries, but there was still billions of dollars, right?
Right.
So they stopped doing that. They stopped the reinvestment. So now they're allowing the balance sheet to reduce by about $95 billion a month.
But where does that money go is my question. So they get these payoffs.
They receive that money. They receive that money. It's no longer being reinvested back into mortgage bonds and treasuries. So essentially what it's doing, a lot of times they're getting rid of these things at auctions too. So essentially it's not helping the supply issue out there. And they are not being stimulative at all to the mortgage bond and treasury markets. But
does it stay on cash on their balance sheet? Like, is it cash? Just not assets?
It is cash that they're getting, yes.
Okay. So it's not, when you say fall off, it's falling out of the assets.
Yes.
But it's still remaining in cash. They have the cash there that if they were to, and it's not, like you said, they're going to slow down the selling off before they would go buying again. But they would have the cash to go buy.
But they're not going to do that because that would be an outright purchase here. But what they're going to do is this. When they taper the runoff, when they slow down the balance sheet reduction, well, what that means is maybe they allow $60 billion a month to fall off. The other 35, they're going to take and reinvest again back into mortgage bonds and treasuries.
Yeah.
So that means that if they do this, they're going to be absorbing some of that supply out there in the bond market.
And that could help.
Part of the reason why rates haven't been able to come down because it's like anything, if all of a sudden you got 1 million more homes to come to the market, right? There's going to be demand at some equilibrium price, but it's probably going to be at a lower home price, right?
Yeah.
It's not that different, trying to make it analogous to housing here where you have all this supply of bonds. there's going to be demand for these treasuries or bonds at a certain level, but it's probably at a lower price. And with a bond, price goes down, yield goes up, right?
Yeah.
So I think this is something people aren't talking about. But if they start tapering at the June meeting, even if they don't cut until later in the year, which I do think they'll cut a few times later in the year, this tapering of the balance sheet reduction or
Would have an effect.
that could help mortgage rates.
Yeah. Got it.
I have to say, a person who does not understand the market and does not understand how things impact interest rates could do nothing but watch and listen to this podcast. And just based on the way that you broke this all down, the way you took it step by step from A to Z, they would walk away with a very good baseline understanding of all of the components that play in to our predictions about what rates are going to do. So thank you for that. It is exactly what I described when I said that you break it down in a way that truly anybody can understand. And that's a huge value to people in our industry who really need, yeah, we lost 100,000 professionals with, failure to renew and whatnot. But those of us who are left, who've been here, who've kind of, made it through many, many, many cycles, I think that our credibility is important. And it's one of the reasons that we have been able to persevere through all of the different changes. And part of credibility is knowledge. And so understanding your business and being able to regurgitate that to your clients and your referral partners is a big deal. And partnering with somebody like MBS Highway is a great way to do that. No matter where you are in your knowledge, you can start from anywhere and come away with a much better understanding.
Well,
Yeah.
Thank you, Jamie. And, I think we talked about a few things that could help mortgage rates, but there's no doubt they're elevated now. So, those of you listening, if you're in the mortgage or real estate space, what do we do to gain more business and continue to survive right now? Right.
Today.
Because if you have a bunch of customers we just talked about how we think rates are going to improve over the next year. Well, why shouldn't I just wait for rates to come down by 1%? Right. Why should I be buying now? It sounds like I could save some money if I wait. So I think it's really, to be successful in this market, you need to be able to combat that. And you need to be able to show the opportunity in homeownership. You need to, be able to illustrate to them what the missed opportunity could be if they don't buy today and what it looks like if they wait, because boy, it's competitive now because there's no inventory. But
That's right.
what happens if rates come down by 1%? Black Knight estimates that for every 1% decline in rates, you got 5 million more people that can now qualify to purchase a home, right? So you think it's gonna be more or less competitive if rates come down to 6%? It's definitely gonna be more, right?
I'm so glad you transitioned to that, because that is kind of the next question is, okay, so how can I continue to build the business today, not knowing when or the rates will come down, and how do I talk to my customers that are waiting for that? And so, starting with the first half, we talked about this off camera, that I was surprised to hear that 1/3, and you're the data guy, right? 1/3 of the transactions for refinancing today are to remove MI. And so that's something we don't talk about a lot. And it's the benefit of the increase in equity that people have, and tapping into that and what the reasons are for tapping into it. I'll tell you, there are, I haven't originated a loan in a lot of years, like personally, like I wouldn't be the guy to originate, but I still have my customer base. I have 20,000 customers in the CRM that reach out almost on a daily basis. I hear from somebody, then I give them to our LOs to manage that process. But I'll tell you, in the last week and a half, I've had 3 customers that have reached out and said, I'm ready to pull equity out of my house because I want to buy investment property. And I was like, wow, you're listening, because we push out information like this. And they're rolling up from interest rates in the 3s to interest rates in the 7s. Mm-hmm. But because we explained it in a way where it's like, yes, you're doing that. And, people have the term, marry the house, date the rate, and the whole thing about that. But actually, if you really start looking at it and you treat the equity in your home as leverage, that can help you get to the next step in your financial wherewithal, in your ability to make it through all the seasons of your life and the economic ups and downs. Building wealth in real estate is the number one thing you can do. And so if you can take some of that equity And you can put that in, and we have these programs now that we didn't have just a few years ago. DSCR, debt service coverage ratio. Maybe you don't qualify for that purchase of investment property, but you've got enough equity to put down, and you know that the rent will cover the payment. You can go buy another house. And to the tune of what you just said, which is the chances are that as rates come down, there's going to be more demand. That just means that prices continue to go up and will continue to. And until we have enough supply, and we can determine this, and you, I'm sure, have the data on housing starts, like when will we have enough supply? I hear things like 6, 7, 8 years based on the current rate of building before we have enough supply to meet demand. So that means that we potentially could have, let's just say, a solid 5 years of increase to some degree. Maybe it's not, 10% a year, maybe it's not 15% a year like we saw in the last few years, but maybe it's to some degree 2, 3, 4, 5% a year. Why not take that massive built up equity and parlay that into acquiring other property? It's not easy today. I'm a buyer. It's not easy. It's not easy.
Me too. It ain't easy because so many of them don't pencil with where rates are and such. But
it isn't. But I'll tell you what, you buy
saying-
one property, and here's another strategy, and I think this goes nationwide to some extent, but I know California in particular has a big push on ADUs. So that's accessory dwelling units. That's putting another unit on your property and creating housing where you, as kind of a small builder, can create housing to meet the housing shortage. They have not laxed the guidelines. They have given a push. They even do grants. If it's on your owner occupied property, they'll give you a grant of $40,000 toward that ADU to build it. Well, now you're talking about building additional revenue that you can help to offset your own payment. So, these are things that I think that loan officers should be talking about to build their business today while we wait for rates to come down, and encourage your customers, your clients, to get out there and look at this as, I'm going to buy now because I know that property values will continue to go up. And when the rates come down, it's a pretty easy thing to refinance. If you qualify at the higher rate, you're going to qualify at the lower rate. So, this is information you guys share almost every day. I'm not the guy who's coming up with these ideas. Of course, I've been doing this a long time, but I hear you guys saying it makes sense to me. And so we repeat these thoughts and strategies with our team. But yeah, if you can, maybe just take a moment, because this isn't like a promotion of MBS Highway. That's not the purpose of this podcast, but there are so many great tools on there that we use to help us in our business. It'd be great for you to just touch on just a few of those things that you could see today in this market that could help a loan officer to originate more business.
Yeah. So in getting there, I thought that was beautifully said, by the way. But I think you bring up a really good point in that every week we get mortgage application data from the Mortgage Bankers Association. And I think most people will be surprised that 30% are refinances. Now, there's probably not many rate and terms there. There's definitely some removal of MI thanks to amortization and appreciation, but a lot of them are cash out refinances. And listen, you don't want to come up with the objection yourself, right? This isn't something that's going to work for everybody, but I guarantee you, if you're trying to strum up some new business in this market, you can help some of your people in your database. You could probably get 1 or 2 deals a month if you reach out and run through a scenario with them, because just think about consumers. There's a lot of signs that they're under stress. We talked about the inflation, but how about the debt? Outstanding credit card debt, record highs, rates on that credit card debt. So servicing that debt, extremely expensive, record highs, because the Fed's hike so much and that goes up in relation to it. How about all these buy now, pay later programs? These have grown massively over the last 2 years. And like 30% of them are being used for groceries. If you're using buy now, pay later for groceries, you're under some stress, I think, right? So even the jobs report today, multiple job holders went up huge. So that's people that need to get another job to make ends meet, most likely. So a lot of consumers have a ton of credit card debt, a ton of revolving and installment debt. And you may be able to help them tap into their equity, which is near record high levels, take them to a higher rate, consolidate some of that debt, and on their overall obligations, save them $1,000, $2,000 a month, even though you might not think you'd be able to. and even taking them from, let's say, 3.25% to like 7% or 7.5%. Again, not for everybody, but I guarantee you, if you did this, you'd be able to help some customers and originate.
That's your debt consolidation tool, by the way, which is absolutely fantastic. You just plug those numbers in. It gives you a beautiful spreadsheet showing your customer what they could save, even though they're going to a higher interest rate. So,
Now,
and this isn't selling people, by the way. This is not selling. This is helping.
This isn't advising. I mean, we tell loan officers all the time, you guys, we aren't just looking for our next loan. We're looking to be the lender for life for our clients. We're looking to be the authority. We're looking to be the person that helps them understand and plan for their future and use real estate as the amazing investment that it is. And so you earn people's trust and you earn referrals as a result of it by being the person that they call when they have questions about, is this possible? Does this pencil out? Tools help us present that information to our clients in a way that they understand. Brad and I have had, I mean, my gosh, we've had like people send their grandchildren to us for loans over these decades, not to age us too much, but they have, because they know that we're going to tell them the truth. They know that we're going to look at their individual situation and we're going to give them advice. And I always say, sometimes it's not no, it's just not yet. And in many cases, we have helped people with debt consolidation loans who were in pretty dire straits otherwise. And while on the surface, it might make no sense at all, cash flow is a big deal to these folks. And it's the difference between them being able to be comfortable and sleep at night and not. And so I think that it's really important that we always look to be advisors and not just looking for the next loan to close.
Yeah. I think those are some really good points. And, you know, I think one of the other things, besides getting creative and doing some of the things we just talked about, and obviously trying to provide more value for your realtor partners and help them close more transactions, especially with the NAR settlement, which we could spend another hour talking about. But I think you're going to need to help those listing agents and buying agents to, you know, show why they should be receiving their commission and help them to, have some additional tools and value that they can add. I think you could be a resource, but you need to be an expert on the housing market too, right? Because rates aren't sexy right now, but the media is talking about a housing bubble like they have been. Remember in 2022, they said there's going to be a bubble. We saw 6% appreciation. 2023, they said there's going to be a bubble, another year of 6% appreciation. This year, I'm seeing the same thing.
You're not talking about CoreLogic, are you?
We're forecasting 5% this year, but you need to understand what's happening in your local markets. And you need to be able to articulate it to your customers. And, you know, we talked about some of the tools. I'll show you one. And Brad and Jamie, you guys mentioned a cute saying that people say, and that's, well, marry the home and date the rate, right? And that's cute, but unless you explain it to the customer, it doesn't mean that much to them, right? So here's how I would explain it to them. And I would tell them that, look, I know you're looking to buy this $800,000 home. And, you know, today rates, let's say, are 6.75%. I know that that's high. And you think that rates are going to come down. And I agree with you. Let's say they come down by 1% next year. So they're 5.75%. You definitely would save some money, right? But what they're not contemplating is this. In this market, in this zip code, we're expecting a little more than 4% appreciation. Doesn't sound like much, but that means that $800,000 home would not be $800,000 next year. It would be $834,000. And you said you wanted to put 20% down on this home. Well, that means that today you borrow $640,000, but if you wait a year, because the home price goes up, if you want to have the same loan to value, you'd have to borrow an additional $27,000 in change. You'd have to also come up with a little more of a down payment. But listen, there's a cost to dating the rate today, but there's a bigger benefit of marrying the home today. So let's go through that with you. Your payment today at the 6.75% rate will be $4,151. If you wait a year, it would be $3,893. So you would have a savings there of $258 a month. Now, that's a cost today. But if you wait till next year, you're going to have that cost over the next 12 months. So over the next 12 months, the cost of dating the rate is about $3,100. And then when rates do come down, we're going to be monitoring this thing like a hawk for you. We're going to refinance you. But guess what? There's a cost to refi into the lower rate next year too. Let's say that's $4,000. So let's go through it. You got your payment difference, $3,100, cost to refi $4,000. The cost of buying now, the cost of dating the rate is about $7,100. But let's go through the benefit of marrying the home today. Well, just 4% appreciation, you gain $34,000 in appreciation alone over the next year. By the way, if you were renting, you'd be amortizing this loan and have an additional benefit as well. your net benefit of buying today would be about $27,000 because the appreciation gain is going to dwarf the higher interest rate cost today. And then, of course, we're going to refi into the lower rate. And when rates do come down, it's going to be a more competitive market, and that's probably going to bid prices higher. So, like, this is an example of how I would break this down. And, you know, you can do this in any scenario. I mean, another one that drives me nuts is I just read some articles on like realtor.com. It's better to rent than buy in every market in the country. I almost fell off my chair. I was like, what do you mean? And I looked at the methodology. They're just looking at monthly payment differential. I mean, what about amortization, appreciation, tax benefits? And what about some of the other negative stuff on housing you're not considering? How about, you know, tax increases, maintenance and repairs you don't have if you're renting, cost to sell the home in the future? And then on the renting side, rental renewals are going up about 4.5% a year right now. So,
That's right.
You know, you have to really break it down for them. And I think most people will be surprised to see you're going to be hundreds of thousands better buying versus renting after about 9 years. And there's a reason why homeowners on average have 40 times out the net worth of a renter. But, you know, you can't just not be doing these things. You can't be not providing this for your agents. In this market, if you do that, I think it gives you a big competitive advantage, shows your buyers that you're the expert, and gets them to act now as opposed to everybody who's just waiting for rates to come down.
Yeah, perfect. And again, just to reiterate, those of you that are just listening with the audio, you're going to want to go to YouTube and see what Dan just presented. The numbers just make sense. And when you look at it that way, it's so easy to explain. So Dan, before we begin to wrap things up here, I just have a question for you, because I know you guys report all the time about the Fed meetings and so forth.
Yep.
I don't know, are you literally like watching these meetings?
Oh, yeah.
Okay, so you are. So you know what would be great? I have never seen one like live. I see bits and pieces of it, on socials and that sort of thing. But if you guys could push out the link to these, I don't know if you do and I'm just missing it, but I think that might be really cool for our loan officers and our listeners to tune into at least once or twice and just see like what it's about.
Yeah. So what happens is this: the Fed has their statement that they release at 2 p.m. Right. So let's go back to the last Fed meeting, March 20th. Their meeting is kind of behind closed doors between the Fed members. Right. But then they release their Fed statement, which we dissect. And not at every meeting, but at like about, 6 of them per year or so, they release their summary of economic projections. That has the unemployment rate stuff we talked about. That has that famous dots plot chart and things like that. Right. So they're not going to have that at the next meeting, but we go right to the Federal Reserve website. I'll give you the link, and you can read the statement and read the projection materials. But then everybody could watch what I think one of the most important parts is, which is the Jerome Powell press conference.
Right.
That's right on CNBC, right around 2:30 p.m. Eastern time. I literally just try to not have any calls for that. And I am just watching his press conference the whole time because, the statement's important, but he can say some things that can really roil the markets in that press conference, and you can get some more clues. So I'm glued to the TV at that point, but you can just watch that on CNBC and stuff like that.
Okay. All right. Very good. Very good. Well, awesome. Look, Dan, this has been absolutely amazing. Before we get to Jamie likes, we're going to spring something on you. She likes to ask a question of everybody that is a guest of ours. But before we get to that, I would be remiss if I didn't at least mention on air that we are giving your father our best wishes. We're praying for him and his quick recovery. He announced this morning on one of the videos you push out, the morning update, that he's battling cancer. And we just want to let you know that we care about him, let him know that, and we're praying for his quick recovery and get him back in the saddle as soon as possible. So, Jamie, I'm going to turn it over to you.
That means a lot.
Yeah.
Thank you. Thank you, Brad.
Absolutely. Your dad is so beloved in our industry. And we are pulling for him. So here is my question. You've told us about your journey. You've told us about your college days a little bit. If you could go back knowing everything that you know now and talk to Dan, let's say Dan in the fraternity years, what would you tell him? What advice would you give him?
I would probably tell him, stop chasing the short-term, fun. And I would tell him that to get a head start on what I'm doing now, right, is to focus on what's really important, get more serious, And I think I wish I could know what I know now going back then, like many people, right? But yeah, I'm glad I finally came to my senses. But it would have been great to have that many more years of a head start. But hey, we can't go back in time, right? All we can do is try to be the best version of ourselves today and make ourselves proud going forward. And I got to say, it's been a challenge. Everybody's got challenges, right? So whether you know it or not, every person that you're encountering with is dealing with something in life. That's life, right? It's like one problem after the next, and it's how you react to it, how you overcome it, right? And and my family personally is going through some challenges right now. My father, my hero, he's obviously gonna be less present as I think he should in work. So I'm gonna have to try to make my father proud, right? But one thing that has really been moving is, and sorry, I get a little choked up, is just all the nice comments from people like you guys and everybody in our community, our members. So it's been really nice.
Absolutely, Dan. Well, hey, thank you so much for being with us today. We've really enjoyed it, and hopefully we'll have you on again. And when we see that first Fed cut, it'd be great to have you come on and go, "I told you so," or
I'm in.
Remember, we told you. That's all
Love
the
it.
famous words I always hear. Remember, we already told you this. I love that.
Love it.
Anyhow, thanks again, Dan. We'll see you again real soon.
Thanks,
guys,
Dan.
for having me. Take care.
Get Real 411 is hosted by Brad Rice and Jamie Kavanaugh, produced by Stuart Jellin, and recorded live from the AmeriFund Home Loan Studio in Simi Valley, California. You can learn more about the show at getreal411.com and watch full episodes on YouTube. If you're interested in being a guest on Get Real 411, email booking@getreal411.com. Please subscribe, rate, and review us on Apple Podcasts, Spotify, or wherever you get your podcasts.